Hey everybody, it's Steve, 570-798-7051. Deal Analysis 101, residential rental property. Rental property, buy and hold of almost any type, commercial as well. Larger commercial, you talk about internal rate of return and some other strategies and some other math. We're not covering that here. We're ignoring depreciation. We're ignoring appreciation. We're ignoring all the fancy stuff. We're staying strictly. We're not going tax advantages. We're not going life estates. We're not doing any of that stuff. We're simply saying what I'm putting in my pocket every month, what I'm feeding my family with every month. That's what we're focusing on, because for me, that's what matters. It's great that I have $300,000 in equity on some of my properties right now. That's terrific, but I can only tap that once, if at all. Meaning I can refinance it, I can leave it alone, I can sell for it, but I can't take it monthly. So I'm worried about what feeds my family. If you're going to make $10,000 a year, I'd rather make it on a $100,000 investment than a $200,000 investment, because I'm making double the return and I can invest in double the property. Yes, the more expensive property may be worth more, better tenants, whatever, but it's not going to feed your family more. Comparables still matter. Your lender cares. Lots of reasons they matter. I'm not saying they don't, but it's not going to feed your family on a monthly basis. Everyone says 1%, 2% is the rule. That's great. And it's the rule to tell you whether or not you want to look at a deal, but it's not the rule to tell you whether or not a deal is any good. Monthly rent should be at least 1% or 2% of purchase price. Great. I have a $500,000 building I'm looking at right now. The owner is happy to tell me they just secured a new tenant for the entire building for $4,800 a month, just a little below 1%. So we'll go with it. I had to tell the owner, I said, I'm out. He's like, why? He's like, 1%. You're great. I said, yeah, the mortgage on $500,000 is more than $4,800 a month. So before I even get the taxes and insurance, I can't pay my mortgage. I could have started with the smaller numbers and worked back, but it was faster to do that. So I'm going to throw things out based on 1 or 2%, but I'm not going to necessarily buy them until I look further. Every math you see from every realtor in the universe, rent minus expenses equals, oops, they call it net operating income. It's not net to me, because it doesn't take care of maintenance, vacancy management. It's adjusted gross income, but the same math. Rent minus expenses equals a profit. 14 minus 4 equals 10,000 in profit. That building profits 10,000 a year. If you tell me that building's worth 100,000, I'm looking at a 10% cap rate. Profit divided by purchase price is cap rate. Or for those of you who aren't great in algebra, profit divided by the cap rate you want tells you what the purchase price should be. 10,000 divided by $100,000 purchase price is a 10% cap rate. $10,000 profit divided by the cap rate of 10% means the building should be worth 100 grand. Pretty simple math, but I'm going to slow down here because I've kind of rushed through a couple slides, and I want you to understand the math never changes. Cap rate is always profit divided by money in, value, purchase price, whatever, is cap rate. We're talking about hard numbers. 14,000 rent minus 4,000 expenses brought me to 10,000 profit. 10,000 profit divided by 100,000 purchase price brings me to 10%. That's important because if we look at the safer way, the exact same building, the exact same numbers, rent minus expenses, meaning AGI, what the world calls NOI, minus maintenance, vacancy management pad. That's everything else involved in running a building except for debt. And people tell me all the time, oh, I got plenty of money. I got cash flow from this. I got all the cash flow I need. I don't need a pad. Great. It's great that you don't need a pad. And I don't leave my pad in the bank either. Okay. I take my pad home. But I don't want a building that doesn't support a pad, because I believe every building should survive in a vacuum. If I gave that building to my daughter, could she afford to keep that building running and pay the maintenance, vacancy management, and still have a good return? If not, does that building add as much to my portfolio as I think it should? Now, if you tell me, oh, that building is a feature building, it's a legacy building, it's worth more, it's more beautiful, it's more impressive, whatever, great. You can choose to lower your cap rate, but you won't be making the same cap rate if you don't take MVM into account. Back a slide. I used to buy at 35%. You can't do that anymore. The deals just aren't out there at 35%. So you're going to have to decide. But if you think about it, you're going to pay a management company 10%. So 15% is probably where you kind of want to get off the train, because you're probably going to have 5% in maintenance expenses, and you might not even be able to cover any vacancy. So if I have the same $14,000 that we started with on the other page, 14,000 gross rent, 4,000 expenses, now I'm doing 20% of 14,000 for 2,800. Now my building's only making net operating income profit of 7,200. I've gone from making a profit from the exact same deal of 10,000. I'm now making 7,200 because I took into account the expenses that are going to exist anyway. I know it's horrible. You really want to take into account your expenses. Same math. Profit over purchase price is cap rate. Profit over cap rate is value. It's the same game, different numbers. I'm plugging in 7,200 over the 100,000 asking price. That building's only making 7.2%. I'm a realtor. I love buyers. I love selling property to buyers. But when I see an NOI, I tell my clients what it's going to be after we take out a maintenance vacancy management pad, because I would rather see them buy a survivable deal than put money in my pocket. I can't let them go down that road. If they say, no, I still want the deal, I'll buy it for them. But I got to let them know that what they're seeing as profit isn't going to contain their maintenance vacancy management. And I've seen all kinds of math of how people do this a different way. I'm just using this way. There's multiply the rent by 11. There's other math, but I'm using this way. So that building that was making a 10 cap based on the realtor's statement of profit, which is not a lie, it is true, is now making a 7.2 cap, a 7.2% return, 3% less. So if you take the same 10% cap rate, the cap rate you want to make, an AGI of 10,000 says the building is worth 100, the NOI tells me it's worth 72. So you just have to really decide, which way are you buying? It's a personal preference. I then subtract from that value all the repairs and maintenance expenses needed to make the building worth the rent, meaning the day I buy it, what do I have to do to it immediately to either get it to those numbers or keep those numbers? If I've got outdated kitchens and barely functional cabinets and whatever, those might last a month, they might last a week, they might last 6 months. But at some point, those cabinets are going to go. That's a $5,000 expense to keep the property in the same place. Yes, you say the tenant new cabinets, that's great, and they will emotionally like it. But it's kind of like, hey, I have a 72 Ford and I put a new engine in it. Oh, you mean it runs? You can't have a kitchen without cabinets. So there are certain expenses that have to be done to keep a building where it should be. Now, let me just jump back here for a second. Lots of people sell pro forma value, meaning if you buy this building and if you do these things, it will be worth this, and therefore my building is worth more. There are cases where it's true. If you're renting out at $300 a month across a bunch of units, and I know tomorrow, they're all month-to-month leases, and I know tomorrow I can raise everyone's rent or kick them out, I might give you a little room for pro forma, but I don't want to pay you for the value that is going to come from my sweat and my expense. So I always buy on current value. I don't buy as much on future value. I might throw a couple dollars in that direction depending on the circumstance, but for the most part, I ignore a pro forma. I want to see what the building's performing now, because that's how I'm paying my mortgage the month I buy it. Cash on cash return. This is your cash flow after the mortgage payment compared to your cash out of pocket. Profit over down payment cost is cash on cash rate. Profit over cash on cash rate is down payment. Now, again, let's remember the numbers. Gross rent of 14, expenses of 4, MVM of 28, AGI of 10K, NOI of 7,200, and let's just pick a mortgage number of 2,200. I'm going to just fudge it a little bit and just use that round number because it brings the 7.2 down to an even 5. So now we have $5,000 profit, but we've only put 20% of the purchase price down on the property. So we've put down $20,000. instead of 100,000. So our 5,000 profit is tiny compared to the 100,000 that we started with. But our 20,000 out of pocket is tiny compared to the 100,000 we started with because the bank's giving us 80. So now I've rocketed to making 25% cash on cash, meaning my 20,000 is bringing me 5,000 every year. I'm only bringing 5,000 in my pocket, but I can do that five actually, more times with the same $100,000. So now, if you have $5,000 profit coming from each $20,000 investment, and I can do that 5 times, 20 times 5 is 100. I started with 100,000. I'm making $25,000 a year on the same money that I would have made either 10 or 7, depending on how you make your argument. Now, again, my 5,000 is based on 7. So if you do 5 times 7, you're at 35,000. So if you don't like maintenance vacancy management pads, cash on cash is king. Leverage is king. There is no reason in this industry to leave your properties without mortgages. Again, you say, I don't need the money. I don't need this. I don't need that. But you can buy more property with the same money. I usually buy based on current income. I kind of jump the gun on the pro forma conversation. Always account for rehab and other expenses needed to make those numbers. Anyway, so this is my little deal analysis 101, 570-798-7051. We are also a management company now. Please call us if you want to manage. 570-798-7051. Thanks.